Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for the second time my friend, Mitchell Scott. And Mitchell is a portfolio manager at Choice Equities. Mitchell, how's it going?
It's going great, Andrew. Great to be back here with you again. So thank you for having me back on.
Look, I'm really excited to have you back on. I've been meaning to have you back on. If you had asked me before we scheduled this, I'd been like, oh yeah, Mitchell came on like 4 months or so ago. And it's been a year. So let's talk all that in a second. Before we get there, quick disclaimer, remind everyone, nothing on this podcast is investing advice. That's always true, but I think we're actually going to hit 2 stocks today. So just remember, double the due diligence for you, double the work, double the not investing advice, consult a financial advisor, and all that jazz. Mitchell, the reason we wanted to have you back on is A, I wanted to have you back on. You're a sharp guy. I love having sharp investors on. But B, we wanted to do something a little abnormal. We wanted to do an update on Crocs because it's been about a year. The stock's actually done quite well since our last pod. But I think you think there's a lot of juice on the bone. I was just reading the Q2 call. Things seem to be going quite well over there. So we'll start with the update there, and then we'll go to Magnite, which is a very popular stock among event-driven value small cap investors. And you said you want to talk both. And I said, normally it's one stock, one pod, but Clemson's having a little bit of a down year in college football. So I'll toss you one bone. But why don't we start talking Crocs? People can go listen to the first pod. I'll include a link to it in the show notes. That was August 2023. I'd love to just get your updated thoughts, and I've got some updated questions for you. So I'll turn to you.
Yeah, absolutely. Well, my day job gives me a great diversion away from the Clemson, Georgia opener that was a couple of weeks ago. That was pretty tough. Crocs, yeah, really just an update, I think, is in order. Magnite, there's kind of 2 business segments there. So depending on how you want to break it up, we'll kind of do that. And some event-driven stuff for sure that's pretty interesting. But Crocs probably belongs, I don't think I've seen it in there, but probably belongs in your why the low multiple series that you've done periodically. And so here it is. It's done well since we were last talking about it. But, I don't know what the stock is up exactly, maybe 30-40%, but the multiple is now.
I think we talked it was a little under 100, and now it's kind of in the 130, 140 range. So something like that. And inside of a year, that's not nothing.
Not bad. And yet, it's got a 10 times earnings trading multiple, 10% free cash flow yield. Most of the things we talked about on the podcast have proven out. I'll say the one sort of caveat is the HeyDude healing, I suppose you could call it. Continues to take just a little bit longer, but it looks like that's sort of about to be turning the corner. There's a lot of things that they've done there that we can talk about that really should be setting the stage for a leg of growth upcoming. And, I think if that happens and when it does, people will start to see a company that looks a little bit more akin to one of these growing brands that, the growing brands, you look at something like Deckers, when they're growing well and getting operating leverage and good balance sheet and buying back shares, they tend to trade on peg multiples. And this stock is not doing that currently. But I think that's kind of the opportunity as we look forward into next year.
So there's a lot in there I want to unpack, and you actually hit tangentially on a lot of the questions I had. But I guess the first is, the overarching question with Crocs. I had this last year. You would have had it 3 years ago if you were looking at Crocs. The overarching question with Crocs is this a fad or is this a sustainable business? And we now have another 13 months under our belt, and 13 months of, you can talk about the continued growth trends and everything, building on international. But I just want to start with that question because that is the key question you're asking when you're looking at the stock and you're answering by buying the stock, right? is Crocs a fad? So how have your views on that evolved over the past year?
Yeah, I mean, I think just another year of support for the thesis that it is a staple of consumer households in America that can be broadened out to other international markets. And so, they got to take care of the brand. They got to continue to market. They got to continue to drive innovation in order to perpetuate that. They continue to do those things. They understand how important they are. We talked a lot about gibbets. I think that continues to be a growth driver for them, and also, equally as importantly, an element of perpetualization for the brand, because you just buy another gibbet and stick it on the shoe, and now you're kind of unique amongst your classmates or whatnot. So they just continue to kind of execute on the playbook. They were a pandemic winner, but I like to really think that they just won during the pandemic is the way I kind of think of it. And continuing to do what they said they would do, and another year in the books to kind of bolster the execution thesis.
If I can just jump in there, the thing that's most interesting to me is the partnerships they do with Crocs, right? It just, the number of brands and celebrities that want to partner with Crocs and do these limited edition drops, and the kind of Nike, when they release, really, new Air Jordans, new LeBron shoes, those are the highest heat items is what they call them. Things that when they stock them, they're going to fly off themselves. And Crocs, I mean, they've got some high heat items, and I'm just surprised by the partnerships. Maybe it's because I think of Crocs from 2008, right? When all my friends who were in med school or, working late, they were doing Crocs, and I was doing crew, and like you'd use it to like stop out to the boats and stuff. But now it's real brands. Like I'm looking at their Instagram right now. Not that this is the highest end brand, but they've got Crocs Happy Meals, and we mentioned the KFC ones. But there's artists who are dropping $140 Crocs that I think they said are selling out inside of minutes and stuff. So. Yeah. There is still a little bit of me that says, these shoes they're so dang ugly and they're not super functional. But when you get this many celebrities, like it does feel like something sustainable. So I rambled a little bit there, but I'd love to just toss it over to you and get your thoughts on kind of how the partnerships are working, driving the brand and all of that.
Yeah, that's been a major part of it, right? Kind of probably the big unlock for them since, Andrew Reese came back into the CEO position in the 16-17 period, is how to connect with the consumer, how to make it relevant. And, all their marketing spend is digital. So, they're focusing on a handful of celebs and collaborators, influencers. And that's how they're getting in front of people. And so they've really segmented who they're targeting for this group of people and that group of people, so they can find a celeb. And, it's pretty neat how it all came about, right? It was Post Malone, I think, was the first sort of guy credited with sort of getting that engine going for them. But all the celebs are kind of into it too. So, that's a real positive that speaks for the brand.
There was an artist, I'm starting to feel my age because they do the MTV VMA Awards, and I know like the only artist I know there is Taylor Swift, but there was an artist who, just glancing at their Instagram, I was prepping for this, I would not assume was associated with, Crocs it's kind of, I don't know if whimsical is the right term, but it is very corporate, right? You can tell these are getting made and sold for profit. It's an artist that I wouldn't have thought would partner with them, right? Like they probably wouldn't partner with GE or JP Morgan or something. But I looked at their Instagram, and the last 10 things they posted was on their Crocs partnership and launching new Crocs. And so, yeah, it's a profitable brand, but people clearly enjoy the association and everything with it. So the other thing on the fad that I thought addressed, again, who knows? Things can grow for a long time and then hit a wall, but the CEO on one of the most recent earnings calls, he said, "Hey, this is our 6th year of double-digit plus growth. Like 6 years of double-digit growth. 1 time's luck, 2 time, yeah, but 6 years is driving on a trend."
That's a lot.
I think you want to say anything on that? Go ahead.
Yeah, I would just add. They're kind of broadening out the silhouette profile as well too. So 5 years ago, sandals was nothing. Now it's 15-20% of the Crocs brand revs. So, that's just one more, a lot of the Crocs are sort of the classic clogs, et cetera, and then immediate sort of spinoffs of that. but you've got sandals, and that's a very big market. And so continuing to drive in adjacent fields.
So I'll quickly ask, I think both you and I are value investors. I don't think we spend, we both probably follow a lot of the, I think it was Peter Lynch who said, if you spend 15 minutes thinking about macro, you spent 10 minutes too long or whatever. We probably follow that. But I do just want to ask, it should come to, if you've been following the market, Nike had a disastrous earnings, was their last earnings, right? Their stocks goes down. Most of the footwear retailers have had pretty poor earnings. Every retailer that I've followed or seen, people can think of the dollar stores have been blowing up recently. All of them have been talking about not a consumer in depression, but consumer weakness, consumer retrenching. And then you read Crocs' earnings, and I don't think they're saying the consumer is just like lighting money on fire, but you're not really seeing them talk about consumer weakness. That is a little bit of a sign of a brain shake, but I just want to throw out like macro consumer. Do you have any concerns, or are there any worries? What is Crocs doing different than everyone else?
I would be more concerned if it was trading at 28 times earnings rather than 9 or 10. This is kind of the value investor in me and the belief in a margin of safety. But look, if the earnings aren't there, it's not going to be a good stock, right? So the earnings need to be there. As far as macro goes, I love that Peter Lynch quote. I think about that a lot. But depending on how bad things might be, they would be negatively impacted for sure, and there would be an earnings shortfall, and the stock might not do well for a period of time. In a bigger picture view, the stock can continue to do well so long as the brand continues to be effective and management continues to drive that. So not, macro, not asleep at the wheel on macro, certainly thinking about it. And it is a driver just in terms of consumer spending. This is a consumer product. Crocs is pretty well positioned in the footwear market. The average selling price is $55-$60, and that's a trade down for some people, right? So they're in a pretty good spot with a very broad customer base who, if the products they're selling, if the products they're putting out continue to have relevance, I think they'll do fine. Just because it's not high luxury, which is sort of immune to most cycles, but it's not $175 shoe that people are going to trade down out of.
Someone on the Q2 call, I think it was the Q2 call, maybe it was a conference, but they said something along the lines of, hey, you guys are selling in Walmart. I saw you on Walmart.com. I'm surprised by that. And I'll let you, I can tell you what the CEO said in response. I'll let you take that. But I remember 5 years ago, 10 years ago, I think it was Competition Demystified. And it talked about how a lot of brands have to choose not to sell to Walmart, because when you do that, Walmart is such a big player, they will relentlessly grind your margins down, and eventually you're just kind of commoditized and you're making no margin. And when I think of footwear brands, Nike's not selling in Walmart. I don't think Adidas sells in Walmart. Like, a lot of the footwear brands don't do it. And again, I'll let you respond how the Crocs CEO, but I was a little surprised by that, right? Like, this isn't Crocs, the upstart. 15 years ago, they almost went bankrupt because they were selling, every gas station in America was selling Crocs, right? Like, they almost destroyed their brand. I'm a little surprised by a business that we just talked about. It's not a fad. They've got a lot of people who want to partner with them and everything, but they're selling Crocs in Walmart. I was just a little surprised by that. So I just wanted to touch on that with you.
Yeah, that's a good question. We followed up with management on that after the call. So the first thing I would say is, that's not new news. They've been in Walmart for several years.
Yep. It was funny when he asked him, the CEO was like, well, we've been there for a long time. So yeah, I was a little embarrassed for him, but it was the thought process behind it is what really interested me.
And to your point about the margins, so I don't want to get overly granular on like one particular quarter, but they've got no problem with margins, right? So most recently, gross margins were up healthily. They've got industry-leading gross margins and profitability margins. I think your question is probably a little bit more about, does this impair the brand's ability to sell at full price over a longer-term time horizon? And so, thus far, the answer is no. Walmart, a lot of the Crocs core customers shop at Walmart. And, if they feel like they need to be in Walmart, that's a decision I'm sure that they've carefully considered. And, they're managing appropriately. They do a pretty good job of managing their channel approaches. So they're pretty diversified. So that's kind of how I would answer that.
Let's quickly talk about the HeyDude acquisition, right? I think when you and I chatted last year, the HeyDude acquisition it had just kind of completed. And I think it was a big point of bull bear debate on the stock, right? Bulls would say, hey, this is a management team you want to execute, new vertical, all this sort of stuff, look at the growth. I think bears looked at it and said, this is what brands do when they're stalling out in growth. They go buy something and it's completely different, and it's the first step of them kind of starting to stumble. And we all know companies that, they had a growth business, start to slag, they buy something new, and then management takes their eyes off both balls and it falls apart. Love to talk to you about how the HeyDude acquisition is going in your mind now that we're kind of 2 years into the acquisition. And feel free to mention Sydney Sweeney, the new director of what is she? She's the new I can't remember what her role is, but she's the new director of product marketing. Feel free to mention Sydney Sweeney as much as you want, because I'm sure it can't hurt the YouTube algorithm.
Yeah, right. Yeah, I was just on the line with her last week talking about inking the new directorship of Dude, and she seems pretty fired up. I've not spoken to her about it.
I was about, you got a little more pull than I thought.
Yeah, no, that's not true. So, but I do think she's going to be really good for the brand. Just in terms of how HeyDude has gone, I mean, to your original point, yeah, I would say kind of both are true. There's enough evidence here to suggest both are true. I think what it's going to show in time is it was really just a digestive phase for the acquisition, and it's going to end up being a good one. So there's a lot of things you can point to, but in terms of just strictly looking at the here and now and consolidated financials and the numbers they're reporting, it doesn't look great. So when they bought the brand, I think they had $1 billion in revs. Now they're $850 million. And we kind of talked about it, right? So a little bit too much product in the wholesale channel, changing wholesale channel partners, kind of took some wholesale channel partners off. And so they had to manage through that. But what they've done is, the right thing for the long-term health of the brand. And that appears to be, I would say, running its course sort of now. And so what you're seeing is, and this is always interesting in kind of consumer products companies, right, is, what are they doing with the marketing? Arguably they were playing kind of rope-a-dope for, a handful of quarters while they were cycling through inventory that was in the channel that they needed to clear out and get into a healthier position. And so inventories are down on the books and in the channel. The commentary we're hearing from, end market partners is really good for the first time in a while. So there's some real excitement about some of the new stuff that they're putting out there. They have a new chairman of the brand of HeyDude, Terrence Riley, who's got a really well-regarded background as a marketer. And so, one of the first things he's done is brought Sydney Sweeney in. And she seems to, at least in terms of driving engagement online, she seems to have had somewhat of an, immediate impact. So that's really promising. It's kind of interesting to see what he did there. If you think back to what he did at Stanley, he took that from 70 million in sales to 700 million in sales, like 4 or 5 years. That was kind of a good period probably to be doing that. But that's meteoric growth. And how he did it, Stanley was an old Army coffee cup company, right? And so he just really got in front of the female consumers and drove interest with them and then broadened it out from there. And so somewhat like that, this is kind of how he's decided to make Sydney Sweeney the chair of Dude. So they're trying to be a little bit more relevant with the women, and then the belief is the men will follow. And so we've seen that before, and it's a little bit of a different angle, but seems like it's off to a good start. So you're seeing some of this show up in recent reports. Their unit sales were down, but their ASPs were up. So healthier position. We're looking at stuff online. We're talking to people that feels healthier. And so now they've got some new shoes, new SKUs, new silhouettes. And he's got a very large budget, relatively speaking, to spend on marketing in the back half of the year. So that's part of what Sydney Sweeney was. So anyway, feels like a lot of the heavy lifting in terms of getting the brand in position to grow and succeed and respond to marketing has all been sort of put in place.
Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. I should have asked you earlier, but I'll just ask here. I think it was a little forgetting because we had done it, but I like to ask every guest for every stock we pitch. Market's a competitive place, right? Yes, Crocs trading at 10x earnings, but that's just anyone can see that number. What do you think you're seeing in Crocs that the market, the average investor, whatever it is missing that makes Crocs an alpha opportunity?
Yeah, that's a really good question. I mean, I think if you just look at the whole body of work, what you see is a management team that has proven marketing muscle and an ability to drive product innovation. And so I like the HeyDude brand. I think it's a natural fit with the Crocs brand. They're going to piggyback on international distribution partners that they already have for Crocs, and basically the same playbook. So I think they've got the right playbook. I would also say the business is just incredibly profitable. I mean, it costs like $14 to make a pair of Crocs, and you sell them. The MSRP is like 55. All in it's 30, 35. So it's almost a 60% gross profit margin and 25 to 28% op margin with 3% capex or something. So just generating a ton of cash. So if they've got reinvestment opportunities and they can continue to drive new sales through that, they should be able to drive earnings higher, buying back stock, and it should re-rate once they sort of cycle past these sort of down growth numbers to a more traditional multiple that's higher than 9 or 10.
I'm glad you mentioned reinvestment because that was my last thing I wanted to touch on here. Right now, I'll give the numbers. Right now, Crocs has a market cap of about $7.5 billion. In the past 12 months, they've bought back about $350 million of stock. So, that's almost a 5%. Let's round it up among friends. That's almost 5% of the stock retired at kind of the current market cap, right? They probably did a little more because they were buying a little low, but about 5%, not nothing. And these guys generate a lot of cash flow. Alongside that, they've taken debt that mainly came from the HeyDude acquisition. They've taken debt down from $2.5 to $1.5 billion over, let's call it, the past 18 months. So, I mean, that's a lot of cash flow. That's a lot of capital allocation going to debt pay down, to share buybacks, and that sort of stuff. Now, if you read the calls, they are kind of at where they want to be in terms of leverage. So business generates a ton of cash. I want to ask you, what do you expect? What do you think about capital allocation going forward? I think the main answers are, you could tell me the game is on. They are going to be retiring stock aggressively. Switch it from $350 million in stock buybacks and $1 billion in debt pay down to all the stock buybacks. I mean, that's a lot of stock buybacks. Or you say, hey, they just did HeyDude. They're excited about it. They think it's about to start really growing. They're going to look for the third leg of the stool. They're going to look for the fourth leg of the stool. So I've led you on two paths. I'd love to hear you. Do you think it's path A or B? It could be, a combination, or it could be path C. They're going to get into space rockets or something else. I don't know. But I'd love to hear what you think capital allocation looks like going forward.
Yeah, I definitely hope it's not path C. And I don't really like path B all that much either, at least in the near term. So, and we've, whenever we speak with them, we kind of throw in our 2 cents. Would really prefer to see share buybacks here. And it's in the company's history. It's in their DNA. They've been through 2 different spots where they, gobbled up 20 to 25, maybe even 30% of the float at 2 different episodes. And, it's been one of the better performing stocks in the market over the last 5-10 years. And that's a big part of it is the capital allocation. Yeah, capital allocation and reinvestment opportunities, right? So if you can get those two things at a reasonable valuation, you can really get good returns.
It's interesting you say reinvestment opportunities, because reinvestment opportunities, you think about like really deploying cash into CapEx and stuff. And like here, it is growing, but it's kind of nice because, as you said, now this can change, because any brand, any consumer focused thing generally is going to grow capital light, but it's going to have all this growth and it's going to be pretty capital light in the growth. Yeah, they need to fund some working capital and some accounts receivable, maybe a plant, but they can grow. It's going to be pretty capital light, any incremental growth, and they could grow at a 20% clip and still buy back 20% of their shares. And the key thing, you're underwriting, this is not a fad. This brand is sustainable. It's not about to go off a cliff. And we've all seen brands go off a cliff for many, many a reason. But that's kind of the nice thing if you get this right? That's why the big winners often come in consumer, because they can grow capital light for a long, long time.
That's exactly right. Yeah, I mean, that's a major part of the thesis here. If they end up being aggressive with share buybacks here, I mean, they bought 2% of the float last quarter. So even if that wasn't aggressive, I mean, that's 8% a year. I mean, that's if you get, 10% net income growth, and then you get that along with that, that's a really nice result from 10 times earnings.
Great. I think, any last thoughts on Crocs before we move over to Magnite?
No, I mean, I think a lot about sort of what people in the market want. And they're a little bit of an investment here. So this is kind of a negative EBITDA quarter for them, but I think it's, for all the reasons we just talked about, I think it's the last one, or at least it appears to be setting up that way until they get to sort of a smoother growth algorithm that growth investors are more accustomed to seeing. And I think that's what might lead to the multiple expansion.
You know what else will help? Their CEO, his first name is Andrew. And, you always want to bet on CEOs named Andrew. So
what is that?
Let's turn to Magnite, the second stock we're going to talk about. I will let's start with this. So I have done a podcast on it about 15 months ago. I'll try and include that in the show notes, but I'd love to start just quick overview. What is Magnite, and why is every value-oriented event investor I talk to on the small cap side, why are they so attracted to this company?
So maybe it's because it can be complex. And so your podcast with before with Daniel Day was really good. Was Daniel Day? It was Daniel.
Yes, that's correct.
Yeah, okay, because that's the CFO's name too. So, just briefly. If you think about it a certain way, I like to think it's not that complex. And so really it's an exchange. In this case, it's an ad exchange. But so what are the, key considerations if you're evaluating an exchange? What are the typical sort of competitive dynamics? What are the financials tend to look like? So, it's all about getting the volume, right? And then they connect buyers and sellers, and then they take a commission or a take rate. And, it's up to that particular exchange to, do whatever it is they need to do to recruit the right partners on the buyers and the sellers, get them on their exchange, and then they get a small little piece of each transaction that happens there. So that's kind of the big, broad picture.
Can I just correct me if I'm wrong, but I believe listeners might be familiar with Trade Desk. Trade Desk, if I remember correctly, is a supply side.
That's right.
I can't remember if they're managed, but Trade Desk would work with your Colgates, your Cokes, and everything. So they would aggregate the advertisers, and then someone like Magnite would aggregate your, their actual partner, and we're certainly going to talk about it, Netflix, Disney, the people who are actually providing the inventory that you're watching the ads on, they're going to aggregate them, and then they kind of meet in the middle and match everyone up. But so they're working with your Disneys, your Netflix, the people, your Yet Another Value podcasters, your people who are inserting ads into them, not the actual advertisers themselves. Am I kind of thinking about that correctly?
You were thinking about that exactly correctly. Yeah. So what I was going to say is it's kind of like a bow tie or an hour. And this market has developed a little bit differently than, say, a stock exchange or what have you. So, yeah, you got publishers who own ad inventory that they want ads placed on. Magnite will represent them because this is, on the open internet, on desktop and whatnot, because that's like trillions of impressions, like little ads getting matched. This stuff is the pipes, and the connectivity is all somewhat complex. So Magnite would represent them with their pipes. They would sort of highlight their inventory. There would be somebody in the middle that would sort of process the ad back and forth. The trade desk would be on the demand side platform representing Colgate, Palmolive, whoever it is. And then it all sort of connects through there. So we can spend time going down the rabbit hole and talking about the understanding the pipes and whatnot. From a big picture view, I place a lot of importance on understanding sort of what's happening with the market and then who is on the exchange. So who are the major partners? Who are the major customers? Who's driving the inventory? That kind of stuff.
And I'll just note, not to talk up someone else's research as well, but our mutual friend Ryan O'Connor had a fantastic, at Crossroads Capital, had a fantastic piece just this month that I'll also include a link to the show notes if anybody's interested in learning a little bit about that. Mainly focus on the DOJ upside, which I'm sure we'll talk about, but I have to mention that because it's a big piece and it's well worth reading. All right, the same question I had with Crocs. Market's competitive place. What are you seeing in Magnite that the market is missing that you think makes Magnite an alpha opportunity?
Yeah, that's a great question. And just a second, your comment on Ryan over at Crossroads, they've done a really good job. It's worth checking out. Yeah, what I would say, so I was speaking with somebody about this the other day, and it dawned on me that, every time I speak with a potential investor about Magnite, I get two reactions. The first one is a groan, and then the second one is a yawn. And the groan basically comes from highlighting something that is an ad tech player on the supply side. And for the last decade, that has not been the place to be as an investor on the long side. And there are a lot of reasons for that, but primarily in the one sentence, I would just say that Google has just completely owned that space and given anybody really trying to compete there a very difficult time and have given them, not a great impression for investors to invest on that side. And then so that's kind of the groan, in addition to the fact that sometimes getting into the plumbing of how the pipes are all working can be a little bit of a cumbersome task. So people kind of groan there. Then they look at Magnite and, I guess right now the stock's down and there's, 600 million in revenues. It's a small cap company at $2 billion. And are they really going to, make a meaningful difference in this world? And then they kind of yawn and move on to the next. So there is sort of the stigma, I think, that has somewhat followed this company for some time, not necessarily as a fault of their own, but really just a symptom of the space. There are a lot of reasons that may be changing. The Google antitrust thing, that could change things dramatically. I'm not an antitrust expert. I think even antitrust experts are still, it's a bit of a wild card, right? How this is going to play out.
Well, I've done a lot of antitrust, and I can tell you take one case to two different antitrust experts, and it's like, it's a lock, the DOJ is going to win. It's a lock, the DOJ is going to lose. So I don't, as you said, I don't even know if antitrust experts are that expert.
Yeah, exactly. So that's kind of critical in our minds. What I would say is the CTV space that Magnite's been really focused on since 2019 looks like it's going to unfold differently than the open internet space did for the SSP relationship. And I've followed Magnite, Rubicon off and on for a decade now, which is really a long time. So I've been watching them kind of quietly building to this moment. On both sides of the business, the DV Plus and the CTV side. So the CTV business, I think, as an SSP, has inherited the stigma that the DSP and the open exchange, open internet business bestowed upon it. So, but what Magnite looks like they're doing is, they've basically acquired or bought anybody good on the SSP side of the business. And folded them up in-house. So they bought Solaria, they bought SpotX, and then they bought SpringServe. And so there's really nobody left on the SSP side and CTV that is digitally native, that was sort of born to do that. And, what we see time and time again is it's just really hard. And people have tried, and, Xander basically just got fired or replaced by Netflix, by Magnite. By Netflix with Magnite. And so you're seeing that pattern emerge time and time again. So long-winded answer to a short question. It's the stigma that has followed the company around. And so I think it just takes an open mind to be willing and able to evaluate the opportunity.
No, that's perfect. So I do want to start. I mean, obviously, if you're bull here, what you're pointing to is, hey, Magnite won Netflix, and I believe they also won Disney, right? And you're saying, if you're partnering in the ad-supported video space and you've got Netflix and Disney, like, who's going to be bigger than those two, right? These guys are supplying the tech for them. So I just love to start by asking you, how do you think about the Netflix and Disney deals? And I have some counterpoints to that, but I'd love to start by asking just how you're thinking about Magnite winning them, how that drives revenue growth, earnings, all the stuff people really care about as these relationships really get underway.
Yeah, sure. So, I mean, Magnite won Disney 3 or 4 years ago, I guess, 2020. They've just been getting closer and closer with them. It sort of started out as kind of white labeling some of their stuff, but they continue to get close with Disney. The Netflix win, was up for grabs 2 years ago, and they went with the Microsoft company. Blanking on the name all of a sudden.
Xander? Was it Xander? It doesn't matter.
Yeah. Anyway, just blanking on it. But so they went with them, and basically they got displaced and decided that they wanted to work with Magnite because they were able to do what it was that they needed to be done far more effectively. So huge sort of good housekeeping seal win right there. The CTV market is kind of developing like right now. Like you could see it all coming for a really long time. But people are moving to CTV, but the ad dollars have been delayed and following them, and they're really moving over right like just this year and next year. So Amazon just kind of like click and flipped everybody over to ad supported in January with their whole user base. And this time a year ago, Netflix had no real ad supported users, and now it's 38%, I think, at the end of their last quarter. So it looks like it's going that way. People don't want to pay what they're paying for all these streaming programs. That's gotten incredibly complex, and they'll watch some ads. So this is how linear TV unfolded. It looks like CTV is going to unfold similarly and be financed by ads, and Magnite's going to be there to place them on like a revenue sort of earnings contribution basis. I mean, I don't know what's a bigger deal for Magnite. Just the win of the 500-pound gorilla, and sort of the halo that's provided them, which we understand is continuing to help them win other new business because they're putting all the stuff on their platform. So they're getting the volume, right? So they're the place to transact. But from a financial contribution perspective, it's potentially massive as well, right?
There's a lot of things you mentioned there that I want to touch on. So you mentioned Amazon. Amazon comes in and flips this. And I could view that two ways, right? Number one, Amazon comes in, now you've got critical mass where it's like, hey, if we're a retailer movies, whatever, and we thought we could just go over broadcast TV, we can't anymore, right? Like the eyeballs are on streaming, Thursday Night Football is on streaming, Netflix is going to air the Christmas games. Like we've got to get into this digital advertising space. So you could say, hey, that just like flywheels the whole market up. But my counter to that would be, I think Netflix is doing their DSP internally, right? So they're doing their platform internally. And I just, with Crocs, we talked about, hey, why doesn't Nike sell through Walmart? Because Nike knows Walmart's going to grind all their margin out and turn them into like kind of a commodity business. And I think the take rates are really low when you get a Netflix or a Disney. And I worry like, hey, are Netflix and Disney Magnite might have the best tech, but do they just grind Magnite's margins down to nothing by saying, hey, if you guys are making anything on us, we're just going to in-house it, and you need us to make the rest of your business work. So they, and doesn't mean it can't still work, but I worry like maybe Netflix and Disney are kind of loss leaders or neutral. And, I think their margins are 20% versus 5% if they're going with really small players. So all the profitability has to come from small players. I threw as I'm trying to do, I threw a ton out there. I'll just let you start. And if there's any piece you miss or you want me to remind you, I'm happy to.
Yeah. So, I mean, effectively, the question is the big customer wins. They're really just going to kind of abuse Magnite and squeeze their take rates down. Yeah. It's a good question. Certainly something we've looked into a bunch. It's a little bit of sort of another version of the buy and build question, right? Like, why don't they just do this themselves? And that's kind of what I was pointing to, and sort of the long lead in is there's not really anybody out there that has successfully created a CTV SSP marketplace other than Magnite. And so the ones that have, they've bought. PubMatic is certainly trying. Occasionally they'll tout really big growth, but the base is really, really small. And Xander tried and seems to have been displaced by Magnite. So that's what we've learned by witnessing how the market has developed thus far. That's a good point for the case there. It doesn't mean that it can't change going forward. But, it just looks like history says it's very hard to build these things. And then the take rate is not huge. So do they want to, take on this responsibility to hire 400 or 500 software engineers to take on this massive undertaking for, something that they might screw up, that might lead them to earn less on their advertising, that, these companies are going to get better and better and better at as they continue to iterate. So, that's always out there. I mean, it's certainly up to Magnite to win the business and keep the business by earning the right to do that. But it kind of comes down to that buy versus build. And what we're seeing today just does not suggest that that's something that they're thinking of.
Can I ask you the question one different way? One of the great things of exchanges is, hey, we charge you more, but you will get more if you trade with us anyway, right? So the net to you is actually a lot cheaper if you trade with us, and that's part of the buy versus build too, right? Like, yeah. Theoretically, could Walmart try to build their own Visa style card network? I mean, yeah, they've got tons of volumes they could try, but the trying to build it's going to be a disaster for a lot of different ways. Maybe that's not the best example. I'll think of a good example either offline or by the end of this. But I do wonder, like, a trade desk could go to a lot of their suppliers and say, hey, work with us, even though we take 10%, because we match you up with so much better people. We're so much faster. Maybe we get better pricing because we're so big, we can lean on people for you. You're actually paying us net less than you would if you went with the cheapest person. Does Magnite have any of that where they could go to Disney and be like, hey, because we get so much advertising as we've scaled you, plus Netflix, plus, our 100 other people, we have so much inventory, we can pick the best inventory for you. And even though we take 5% and a different person might take 2.5%, or if you internalize it, you kind of get zero, even though you have to think about all the engineers you hire, we're going to get you 20% better pricing. So our 5% is an absolute bargain. Do they have that working for them?
Well, that's what I think that they're creating, right? And part of that is sort of Magnite did the buy and build, right? By buying up the other competitors in the SSP CTV world. So it appears to be going the direction in which they will have the power to be able to do that. I don't think that they have much of an interest in playing, that card where they're wanting to, take their take rates up for their big customers currently. I think they're very much in the land phase of land and expand. So, this is sort of what you see as the switching cost. The software behind the SSP layer in terms of how you match up what ads need to go where, the podding, all that stuff is pretty difficult. So, by them sort of aggregating all of that demand in one place, the switching costs that go behind it, it just makes it more and more difficult for not a huge market opportunity for somebody like Netflix.
I have 3 questions, and I realize we're running close to an hour, but they are big ones. But only 3 questions left, but they're big ones. Let's start with the first. why isn't this growing faster, right? I hear they land Netflix. I understand it'll take a while to really onboard them. They've got Disney. Advertising dollars are switching here. To my knowledge, Americans are spending more and more time streaming, watching videos, all that sort of stuff. But H1 revenue up, let's just round it to 10%. EBITDA up, let's round it to 15%. Like, yeah, I've got a lot of companies where if revenue was up 10% and EBITDA was up 15%, I'd be, shooting fireworks into the sky. But when I look at, all the things we're talking about here, I'm a little surprised revenue and EBITDA are that slow. So why aren't we seeing a little bit more of the flywheel spinning, if that makes sense?
Yeah, totally. It's a fantastic question. And, I left that out of sort of how and why is this bargain created or this mispricing come about. And that's part of it. And it has to do with the way that the market is developing. So, what you're seeing, I think we're still just talking about the CTV piece. So I'll keep it there. But, the return, the dollars through the pipes, the spend on the Magnite ad platform has been about 20%, most of 1H. But, the DV Plus business was up 12%. So in the most recent quarter and probably a little bit lower in the first quarter. So there's a bit of a gap there, right? And that's created, I think, some questions for everybody, investors, et cetera. And what you're seeing is they're winning, with the Netflix and, with Roku, well, not Roku, but some of the bigger players, the more premium ad inventory is coming on board at a lower take rate. And, if we get it, let's say we're having this conversation next year, it's likely that take rate has come up a little bit because the inventory is getting valued a little bit better and they're winning newer pieces of business where they're going through more of the full pipe offering. So, some of the ad server business that they're winning from sort of the linear broadcast sort of legacy folks, that's coming on board at a lower take rate because, they're just placing ads and it's just kind of coming in through. These companies are still learning how to get the programmatic bidding and advertising, know-how embedded into their ads, where somebody like Roku, they're already doing like their ads are already 70, 80% programmatic. So, Magnite is big with Roku. They're getting higher calorie sort of wins coming through their pipes with Roku, whereas some of the people that they've been winning with recently are still kind of scaling up. So, I would just say there's a bit of a gap currently between the dollars flowing through the pipes and then their actual revenues. And that has to do with the take rate in the mix. And it looks like those will be sort of tailwinds from here going forward.
I was watching a Monday Night Football game the other day, and the thing that always jumps out to me whenever I watch anything on ESPN, and I don't know if Magnite handles the ESPN side of Disney or not, but I think this question may be a nicer version of it, but I think this question would apply either way. The thing that always jumps out to me when I watch an ESPN product is how dumb the advertising is. And I don't mean that in the sense the advertisers are doing bad. ESPN, every time I watch it on streaming, right? Not on, I'm a cord cutter, I only watch it on streaming. It's the same 5 ads over and over again for the entire product. And it's even dumber than that because I was watching a Monday Night Football game and they advertised for the US Open. The US Open had ended the day before, and I got hit with an advertisement for the US Open 30 times. So, I mean, if I could hop in a time machine and go back and use the results to go bet on it, I'd happily watch it. But I just want to ask, you can tell me that ESPN is not the Magnite product. That's fine. But I have been a little disappointed, especially when Amazon got it. I thought we'd get personalized ad targeting at this point, right? And that would really start to unlock it, right? They'd be like, hey, Andrew lives in New York City. He doesn't have a car. He never searches for new cars. Let's save GM $2 advertising to him and hit it to Mitchell, who lives in the South and might be ready to upgrade his car. And let's instead hit Andrew with, they don't really advertise fantasy books on ESPN broadcast, but let's hit him with fantasy books podcasts because he buys those like they're going out of style, right? So my 2 questions are, why, you can ignore the ESPN one, but I don't think Netflix or Disney or any of these guys, like, why haven't they gotten more personalized? And is Magnite the key to starting unlocking that? Or is there something else? Because if Magnite's the key to unlocking that, I can imagine a whole heck of a lot of upside as they kind of really start tapping into that. Though my question to you would be, we're in the year of our Lord 2024. Why can't we have this unlocked already? So through a lot of outage again, I'd love to hear your thoughts on all that.
Yeah, great question. I mean, I would just say again, kind of like how I answered the last one. I mean, if we're having this conversation this time next year, I think that stuff's going to be a lot farther along. So, and again, going back to some points.
But you do think Magnite is in the key position to start unlocking that versus I could imagine, hey, the data sits at Netflix. Netflix is the person and then Magnite's just the dumb pipes it runs through. But you think Magnite is going to be a key piece of that because that's a lot of value they can capture.
It is. And so, ESPN, the more and more that this goes on, right, ESPN is going to have more data about their customers. And so they're going to get better with their targeting. And so Netflix presumably already has a lot of this data, right? So maybe they're a little bit further along than somebody like ESPN would be. But yeah, that's what, if you just think about where they're coming from and where they're going, yeah, that's where they're going. But, if Netflix had no paid ad subscribers, 9 months ago, for them to already be there with this stuff, just now, would be moving pretty quick. So it's just part of the uptake cycle. And I would expect for these things to be improving pretty significantly in terms of, and that's a big part of the bull case, right? Is, these advertisers have all this first party data. And that's kind of like the holy grail, right? So being able to use that to drive more targeted ads makes the ads more valuable and, arguably could drive a lift to the take rate in years to come. So that's what's coming. It's just taking a while to unfold and the ads are a little stupid in the meantime.
Are you tired of the endless grind of updating financial models, scrubbing documents, and hard coding? Let's talk about something that could transform your workflow, Daloopa. Daloopa delivers perfect historicals for thousands of public companies. That means every KPI, operating data, financial metric, adjustment, and guidance, all at your fingertips. And here's the best part. Daloopa updates your models in near real time, which is especially important during earnings season, and it's tailored to your modeling format and style. Imagine never having to update your models again. With Daloopa, you can reclaim your time and focus on what really matters, analysis and research. Want to learn more? Create a free account at daloopa.com/YAV. That's Daloopa, DALOOPA.com/YAV. Two more questions. I realize we're running close to an hour, but if you've got 5 minutes, I'd love to. First, the bear case I hit everyone with, aside from some of the other questions I have, is I look at it, I'm like, look, you see it. Ryan sees it. I've got some friends who I would consider some of the most sober-minded analytical investors I know, who when I talk to them about Magnite, they're like, Magnite's going to the moon. When moon Magnite, right? And so we see this big upside case. And we haven't even talked about DOJ. I'm going to get there, but Ryan did such a great job. If we skimp on that a little bit, that's fine. They see this huge upside. The puck's moving here. And then I look. The first thing I pull up is I look insider transactions at Magnite, right? And I see just for the past 4 years, let's go through, non-stop selling hundreds of thousands of dollars every quarter by, up and down the C-suite. I see the CEO, the CRO, the CTO, the CPO, the CFO, the COO. I don't know if there's any more C's to go with that, right? So I guess my question is, insiders sell for a lot of reasons. We all know that. But when you see the pot of gold that could be this big at the end of the rainbow, and then you see this consistent amount of insider selling across the board, I just kind of looked at them like, what are they seeing that we're not? Or why are we seeing something that they don't seem to be seeing?
Yeah, it's a great question and something we think about. You brought the good questions today. This is good. I think about it a lot. SBC, stock-based comp, options, restricted shares is a big piece of everybody's compensation here. So you see this with other companies that are similarly structured. We think about it, but yeah, it's we try to overweight sort of what we're seeing with facts on the ground and our other due diligence efforts and kind of go accordingly.
Perfect. We don't have to touch on it too much because, again, I hate to include a third party's research, but Ryan did a great job. I'll include a link to it in the show notes. But a big piece of the upside case here is the Google DOJ antitrust case. And if the DOJ wins, the implications for third parties and how much business could flow. If you just want to quickly talk through your thoughts on that, I think we'd be doing a disservice if we didn't at least touch on it.
Yeah, no, absolutely. Well, the last week has been kind of fascinating, and Google's been getting sued and from everybody forever, right? But all of a sudden, they're starting to lose cases. So they lost the Epic case, turn of the year, and looks like they lost the last one, and this one does not appear to be off to a very good start for them. It's particularly interesting to hear about how much evidence they've been destroying along the way, and how the judges are viewing that, and never mind the fact that they can write a $2.25 million cashier check and get a judge trial instead of a jury trial. So what I think has come out that's interesting this past week, some of the comments around the ad tech server, but just to kind of summarize what's going on there, at issue is the, view that Google created a monopoly, good for them, but then through anti-competitive means, they extended that monopoly into other elements of their business. And that is what's wrong with sort of their ad tech business. So they had the DSP through their search business, and then they bought DoubleClick and then basically forced all the publishers to buy from them. And if $1 is starting over here for an ad to be placed and it's ending up with the publisher, by the time it gets over here, it's about 50 cents, maybe 55 cents. And so those are super normal take rates all the way through the pipes, from the SSP to the ad exchange to the DSP. It's a little hard to parse out who exactly is over earning if they own all three pieces. And I think that's the real crux of the issue. So, it looks like that business is probably not as important to Google as, say, search is currently. And if they're going to offer some remedies, seems maybe more likely to come in this piece of the business. As for Magnite and these other SSPs that have managed to survive and thrive, it is a monster market share gain opportunity for them.
So in your mind, would the upside be Google just says, hey, you're right, DOJ, we're a monopoly in too many areas, we're just going to kill this piece of the business, and then they basically leave all their supply up for scraps? Do they sell the business? Like, could Magnite be buying the Google ad exchange? Or what do you think the remedy here would be?
That's a great question. I don't know. It could be many, many things. It's hard for me to think of. I mean, I guess the SSP side of the business is probably going to have like $4 billion in sales, but it hasn't grown in the last 8 quarters. So I don't know if that's something people are lining up to buy, right? So maybe it's a spinoff. I'm not really sure what exists. There's a view in the industry that exists that just by altering sort of Magnite's ability to win in these auctions, that pretty instantaneously they'll be able to win a lot more share. So they're number 2 at high single digit share, and depending on how you cut the ad network business, Google's either 85% or they're 50% on just the SSP. So, if some of this stuff came up for grabs and Magnite was able to, pick up, 5 or 10 points of market share, it would be very, very meaningful. So
just the casual 5 or 10% of a $1 billion industry, $10 billion industry popping up.
Yeah, that's right. With exchange economics, right? So, 65% incremental pull throughs on new margins. So highly, highly attractive cash flows.
Perfect. Anything else we should be talking about on Magnite? I think we did a pretty good job, but just want to make sure you don't think we're missing anything material.
No, I mean, stay tuned, right? I think we all are trying to see what's going to shake out. And it'll be interesting. I think the real interesting thing is just think about how it plays out and over what time frame. But we like it because it's trading at a reasonable valuation, is well managed, and CTV we feel pretty good about all these things unfolding the way we think. And the antitrust opportunity is not something that you have to pay a lot for at this point.
I think I think that's the most interesting thing to me. The antitrust opportunity is, a lot of these things, when you'd buy them, you'd be paying some optionality value for it, whether it's 10, 20%. And then if it didn't work out here, I could be wrong. I'm no expert. I'm a generalist. As people have said, this is a difficult and tough space for generalists to wrap their head around, but you're not paying for it. And the other interesting thing is, like, a lot of the Netflix ad supported things to me haven't fully kicked into gear yet. Like I mentioned, the NFL. The NFL games for Christmas are coming this year. So, I think, as you said, 12 months from now, I think you've just got a lot more Netflix volume of advertisements. And I think that really starts to inflect it. But yeah, Mitchell Scott, this has been great. It felt like 4 months. It's been 13 months. We're going to have to shorten that down to feels like 1 month. It's been 4 or 5 months for the next podcast appearance. But Magnite Crocs, this has been fantastic. I appreciate you coming on for the second time and looking forward to chatting soon and having you on sooner.
Awesome. Sounds good to me, Andrew. Thanks for having me. Great to see you again.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.